You're well known for your regime view of the economy. You're the guy with the dot at the bottom of the dot plot because you don't think there's any reason to raise rates. The economy is picking up. We're starting to see a few wage gains. We're going to get tax cut stimulus of one sort or another. So are you any closer to changing your regime and then looking at the need for additional rate increases?
Well, we're certainly keeping our eyes open on this, but I think on the tax cut issue, I'm very much less of a person that thinks that a lot of deficit spending, has a lot of impact on the economy, or if it does, it's usually temporary. So I think the interesting part about the tax cut is whether it will drive productivity higher in the U.S., drive business investment higher in the U.S. And if it does, I think we could get some gains out of that because that would move up the trend growth rate for the U.S. economy. So that would be good if we can get that. But I feel like for now we can be wait and see as far as monetary policymakers on that. And also in the trend growth world, a couple of tenths on the trend growth rate is a big deal. But in the world of watching GDP from quarter to quarter, a couple of tenths doesn't really register. So I think it'll be hard to disentangle over the next couple of years whether you're getting a couple tenths on the trend growth rate or not. And if you are, that would be important, but it'll be hard to disentangle it from the data.
So you're still locked into the same regime and no rate moves?
We've got the low regime, but we're certainly keeping our eye open. I think my baseline case is that we're still in the same regime. I think there's some possibility that this could light a fire under investment and really drive growth higher. And if that happens, I'd certainly take note of that and adjust policy appropriately.
Well, that begs the question of what your growth forecast is for 2018.
For 2017, we were surprised at the upside on growth. It now looks like the first half was just a little over 2%, but the second half now looking like it's going to come in at 3%. So you're going to get 2.5% or maybe a little better for the year. And this is in a world where maybe the trend growth rate is only 2%. So this is good. We're late in the expansion, so I think the natural thing to forecast is that you would slow down from here. But then you've got this tax effect coming on, so maybe you'll get a little bit from that. So we're still in the low twos for 2018, and then slowing down the trend as you go forward.
Well, it raises the question then of whether we're going to get any inflation of any significance, any acceleration that would create a need for the Fed to move faster or more steeply.
Yeah, I think on inflation, we're below target. We really made no progress in the last 2 years toward our inflation target, at least based on smooth type measures of inflation. Core PCE, less food and energy, is 1.5 year over year. That's a low number. It's the same as it was in 2015. Unemployment went below 5% in the fall of 2015, so we've been 2 years in the fours and really haven't made any progress at all. So I don't really think we're getting the kinds of Phillips Curve effects that people so emphasize. One time, not that long ago, you had the natural rate of unemployment setting up at 5.5%. We're now at 4.1%. We've got a jobs report coming out this morning. We haven't really seen any inflation out of that. And I think, we've got to modify our story about the Phillips Curve. It's just not, it's either non-existent or whatever it is the power there is very, very small compared to what it has been historically.
Well, Janet Yellen and Jay Powell have both said maybe we need to look at the Phillips Curve. Maybe we need to look at our models of inflation dynamics. Do you think something has changed that would lead the Fed to change the way it looks at making policy?
Yeah, if you look at a graph I used yesterday about the disappearing Phillips Curve, the coefficient on unemployment has been declining towards zero ever since the 1980s. So that's from an analysis by the Bank for International Settlements in their annual report. So I think there's widespread agreement on the empirics of this that the Phillips curve is very flat and there might be no relationship at all at this point. And so I think you really have to pay more attention to inflation expectations in this environment. Those are also low, although I will say they've moved up slightly in the last 60 days or so. So keep an eye on that.
What are CEOs telling you about, you're optimistic about the possibility of some additional investment. What are CEOs in your district saying about that and about what they're going to pay their workers?
Yeah, I think the CEOs are very positive on the tax bill. They think it's, and it makes total sense. It was all focused on corporate tax reform. So if you're going to tax the earnings at a different rate, this is going to raise the value of the company. This is why the S&P 500 is up, at least part of the reason why it was up in 2017 in anticipation of this. And so I have some sympathy for the idea that you would get this investment boom coming out of this tax policy. The only hesitation I have is that the firms also had a lot of cash already, and they could have done it before, and they really weren't investing at the same pace they have historically. And so we'll see which way it goes. But as I say, as a monetary policy maker, I feel like with inflation pretty low, I can afford to wait and see if that really happens or not.
Well, cap utilization is maybe running 2% lower than its historical average. Is anybody in your district telling you we need to expand?
There's certainly some have expansion plans. There's certainly some that do want to go ahead. I could see the corporate sector saying to themselves, "This is a good chance to make money and take a risk on the big billion-dollar project that I wasn't going to do before." And they may well go ahead with that. But I'm in wait-and-see mode to see if it really happens.
The other aspect of the tax bill that has concerned some of your colleagues is the large deficits it will create. Are you afraid of a crowding out, a rise in interest rates, a lack of capital available for the private sector?
No, I mean, the 1.5 trillion number is over 10 years, so you're talking 150 billion per year. There's some front loading. I'm not a big one for the effects of deficits on rates. I think that's hard to find. Also, it's a global environment, so you've got this global debt story. You have a shortage of safe assets globally. That's having a big impact. You've got low rates around the world. That's having a big impact. So I think the biggest issue with rates is that the 10-year has traded in a range for quite a while, quite a few years here. I guess today it's maybe 240 something. And then you've got the 2-year rising pretty dramatically, so the yield curve's flattening here.
Are you concerned about that? Some people are worried about inversion. You suggested that if the Fed goes too far in 2018, we could see that.
Yeah, the 10-year, 2-year spread is now under 50 basis points, and the reason it's falling is because the Fed is raising rates. So I'm not very interested in trying to raise rates all the way to the point where we invert the yield curve, especially with inflation below target. I mean, if inflation was 3% and headed to 4%, I'd be all over it, and I'd be wanting to get out in front of that. But we haven't made any progress on inflation in the last 2 years, even with the low unemployment rate. So I think this yield curve issue is important. There are a lot of opinions about it, but we should definitely be looking at it. We should give it due consideration, and we should have that debate now, not later this year when it's even flatter.
Well, do you think that it is a sign that a recession is imminent?
Well, it has predicted the last 3 recessions. I have a graph on that as in a December speech. There's a lot
do you think a recession is imminent? Put it that way.
Well, certainly not right now. I mean, everything is fine right now. The question is, how are you going to play this through 2018? Are you going to raise the policy rate all the way to the point where you're willing to have a completely flat yield curve or invert the yield curve? Now, a lot of things could happen. You could raise rates, and it's not a problem because the 10-year rate goes up, in tandem, and the slope of the yield curve stays the same. That would be fine if that's what happens. But if you look at the last 4 years, the 10-year really hasn't been, very high, and you kind of wonder in your mind how you're going to get that rate to be meaningfully higher than what it is in the rest of the developed world.
Before we let you go, obviously we have to ask about the changes that are coming to the Federal Reserve in 2018. Do you expect any change in policymaking or communication under a Jay Powell regime?
I don't know what Jay's going to do, but I would think anytime you get this kind of turnover, that's a great time to re-examine what the committee's doing. I think Jay would probably have some sympathy for that, but I don't know what direction he would. Certainly wouldn't want to pin him down on what direction he's actually going to go in. But we've got dot plot, for instance. You've got press conference issue. So I think there are things that could be considered here.
There's a big conference in Washington on Monday asking whether the 2% inflation target is still a worthwhile Fed policy. How would you feel about that?
Yeah, I think the 2% target is quite important and has been very beneficial in keeping inflation low and stable. If anything, keeping it too low and too stable. But yeah, I wouldn't want to mess with that. I think what we could do is put a process in place where every 5 years we thoroughly review the inflation target and think about why we have it and what we think it should be. Bank of Canada does this, and I think that's best practice right now. So the Fed could adopt that, but you do that on a calendar basis and not let it interfere with the day-to-day monetary policy decision. You do it in a way that is a thoughtful couple-of-day retreat, reflecting on it or something like that, and then come to another decision about it.